Kitco News Outlook 2024 is brought to you by iTrustCapital. Buy and sell crypto, gold, and silver with your IRA.
Hey everyone, I'm Jeremy Szafron, and this is Kitco News. Now, lots to get to this week. The spotlight is on the release of the Consumer Price Index as well as the Producer Price Index, the PPI. This economic data, of course, is a key measure in inflation, and we'll dissect what it means for the broader economy as well as your investments. Adding to this, we're also eyeing the major banking sector as financial institutions like Bank of America are slated to reveal their quarterly earnings. And let's, of course, not forget that it's also an election year, so all eyes are on the Federal Reserve. Their decisions in this politically charged atmosphere will be crucial, with potential impacts that resonate well beyond Wall Street. Now, to help us break down all of this for us, we're joined by Barry Knapp with Ironsides Macroeconomics, known for his insightful analysis and forward-thinking approach. Barry, thanks for coming on with us today.
Thanks for having me.
Yeah, of course. Now, I want to start a little bit here with the economic data, with both CPI and PPI data being released this week. What are your expectations from these reports? And I'm curious how you think the Fed will respond here.
The CPI situation is fascinating in as much as in a lot of ways, we're in a return to where we were for much of the 2010s. So during the September summary of economic projections from the Fed, they actually had this curious forecast that inflation was going to reaccelerate in the fourth quarter. That turned out to not be the case, but solely because of two factors. One was energy prices coming down, but more importantly, core goods prices. And that's the parallel I'm drawing with the 2010s, or 2000s for that matter, where through that period, inflation ran at or even a little bit below the Fed's 2% target, solely because of one factor, which was core goods prices, where prices averaged zero for almost a 20-year period after China was admitted to the WTO and created this massive labor supply shock that put downward pressure on goods prices. Housing inflation ran at 3%, non-housing services, this is sort of Jerome Powell's framework for how to think about inflation, that ran at 2.5% to 2.75%. Everything the Fed had control over was actually above their target. The stuff that was exogenous, that had, was more to do with global trade and the expansion of and extension of global supply chains, that was zero. So here we are. What we're looking at these days is 6-month annualized inflation. It's all the rage here in the U.S. Every time the Fed whisperer Nick Timiraos writes about this, he refers to 6-month average or annualized inflation. Core goods prices are falling at a 2.5% annualized rate right now. That's as deep as the deflationary shock in the early 2000s, right after China was admitted to the WTO. And this is, again, because of a second round of deflation coming out of China. Chinese import prices are falling at 2.9%. Seems unlikely to persist with problems with supply chains. The Suez Canal is the latest example of that. Asian exports are starting to pick back up, so demand is stabilizing. The Fed's got a lot riding on this goods deflation because housing inflation is running at 5%. Core or non-housing services is running at 4%. So when we look at the numbers tomorrow, expectations are for a 0.3% increase in the core that will still leave that year-on-year rate around 4%. Now, housing will put some downward pressure on that because of the lag effect of the way these things are constructed, but it's probably not going back to 3%. And so much is riding on this goods deflationary shock that I just think counting on inflation for the Fed to be able to ease because they can, because inflation goes straight back to target, is a fairly low probability outcome.
Yeah, we've been seeing the Fed obviously switch to a dovish tone in December. That was shocking a lot of people. I'm curious, should we be cautious in over-interpreting short-term fluctuations like this? What should we be looking out for tomorrow? And from your perspective, where is the Fed? They've been doing a pretty good job so far. Do you think that they're going to start putting some of these rate decreases down in March? I mean, the market's already priced in a few of them. Where are we at with this?
Well, the market is expecting the Fed to cut all the way to 4% by the end of the year. And make no mistake, I think that's the level that they do need to cut to in order to open the bank credit channel. Right now, the situation for small banks is quite precarious. This is the most inverted that the Treasury curve has been since the Volcker regime. It makes it impossible for them to expand their balance sheet, to loan to small businesses. There's a big pipeline of multifamily apartment buildings under construction that are going to need to be refinanced into longer term loans or to finance the federal government, which of course in the US, we're going to sell 7 trillion more of security or roll 7 trillion of securities and issue a new 2 trillion. So the Fed's got to cut to 4 in order to loosen that bank credit channel. But in order to be able to cut to 4, and they think they're not going to cut nearly that far, their forecast in December was 4.5%. In order to get that, we're going to likely need the unemployment rate to go above 4 and average hourly earnings to fall below 4. This is what I'm calling the quadrilemma or 4 fours. If we do get that scenario where the labor market deteriorates, which I think is highly probable, when you look deeply at the numbers, they look a lot weaker than the headline numbers do. That will likely call into question the 12% earnings growth that we have for next year. So we're in this really tricky spot to get the ultimate, outcome where the Fed's able to cut enough to really loosen the bank credit channel. But they do it not as a consequence of the economy deteriorating, which calls into question the earnings outlook. So, I doubt the inflation numbers will come down enough for that to be sufficient for them to be able to cut all the way to 4%. And that creates a very tricky and bearishly biased outlook for me for the first part of the year. Not decidedly bearish. They have finished the rate hike cycle. That's a net positive, but they're unlikely to really fulfill market expectations at this point.
Yeah, you referenced the banks there briefly. And like I said in the introduction here, major banks like Bank of America are about to release their earnings reports. What are the key aspects that you'll be focusing on in these reports? There's been a lot of talk about balance sheets, how much credit and debt that consumers are holding, as well as the banks and the government for that matter. So decipher these a little bit for us in our audience, would you?
Sure. Well, the big bank situation, the mega, 4 or so, JP Morgan, Bank of America, Citibank, Wells Fargo, the situation for them is quite a bit different than it is for even the large regionals or the rest of the regional bank sector. I referenced multifamily real estate, building apartment buildings. That is largely financed through smaller regional banks throughout the system. They are in a much more precarious situation in as much as they have to pay market rates for deposit. JP Morgan is getting away with still essentially paying you nothing on your checking account or your savings account. So when we get bank earnings on Friday, it's mainly the major banks. That can be really misleading with respect to the broad banking situation. So big bank numbers will probably be good. The smaller banks, not so much. And there is a huge political overhang on the banking system right now. We get dueling speeches weekly between Michelle Bowman, who was a Republican appointee who does not want to increase the capital requirements on banks, and Michael Barr, who is the vice chair for supervision, who does want to increase capital requirements on banks, and the big banks in particular. The banks have been building cash and being defensive ahead of that potential capital increase, the so-called Basel Endgame rules. That's a political overhang that will probably keep bank stocks from performing well until we get much closer to the election and we figure out whether we're going to have a Republican president or a Democratic president, because it really does all hang on that.
Yeah, no, it absolutely does. And like I mentioned, it's obviously an election year, and the Federal Reserve's policies are under increased scrutiny here. Historically, election years come with their own economic challenges and uncertainties, much like you said. How do you think the Fed will navigate its dual mandate of controlling inflation and fostering employment here?
Well, as I mentioned a little bit earlier, I think the way to think about this is the 4 fours. For most of 2023, the Fed was able to sort of ride the disinflationary wave. They went from hiking 4.25% in 2022 to only hiking 1% in 2023. I would argue the last three of those hikes were totally unnecessary and did little more than drive the dollar up, which helped import prices and good prices on the margin, but was probably unnecessary because of the damage it did to the banking system. They do need to reverse at least those three rate hikes. And from a political perspective, I'm sure they'd rather get started sooner rather than later. In order to do that, though, they really do need some additional labor market slack. And that's my 4% unemployment rate. It currently resides at 3.7, and average hourly earnings coming decidedly through 4. They're currently at 4.1. So the Fed hasn't given up on their Phillips curve basic operating model of that dual mandate. And as such, they'd probably rather see the labor market weaken in the near term so they can start that process sooner rather than later.
Yeah, there's been so much talk about the Fed. Obviously, we talk about it a lot on the macro side of things. There's been a lot of people calling for a possible recession next year. I mean, we've been talking about the deep fakes when in terms of looking at some of this data that's being released and then overanalyzed the month later once we see the numbers and the revisions happen. Has anything been surprising you coming out of the data so far this year, but going into December of last as well?
The economic situation is, I'm not sure what the best adjective for all this is uneven at best. Some have called it a rolling recession. We had a massive inventory cycle back in 2022, biggest surge in inventories we'd had since the 60s, and then inventory liquidation. There were stories about Walmart and Target having truckloads of stuff in their parking lot. We had a recession in the housing industry. We've had the manufacturing sector essentially in recession for 14 months. The ISM manufacturing survey has been below 50, the boom bust line through that period. Now, though, what we have happening is demand for labor is clearly weakening. You mentioned revisions. We've had negative revisions 11 of 12 months. That says to me that the models the BLS uses to estimate things like small business employment, the infamous birth death model, is probably underestimating the amount of business deaths and therefore probably overestimating small business employment by over 1 million jobs in 2023. It's another reason why I think the labor market is weaker. That could lead to weaker consumption over time. And capital investment has weakened as well, other than government-directed investment. And we could talk about whether that'll actually add to productivity in the long run or not. Typically, government investment doesn't. Use China as exhibit A for that. But that notwithstanding, for at least the first half of 2023, we're likely to see the labor market weakening, consumption softening, and capital investment fairly tepid. That may get us towards the NBER scratching their heads about whether this is a recession or not. We may not quite get there. If we do, it'll be shallow. But we're definitely going to get weakening of growth. And those three elements are crucial to equity earnings, right? We did have an equity earnings recession the fourth quarter of 22 and first half of 23. We're coming out of that, but expectations are for something like a V recovery in earnings. And if I'm right and consumption weakens, the labor market's softer than the headline numbers imply, and capital investment is fairly soft, we're unlikely to get 12% earnings growth in 2024, which does call into question the reasonably elevated equity market valuations at this point.
Right. Yeah, let's switch over to that. I mean, let's look at the current market trends, including the tech sector's recent performance and the manufacturing sector's ongoing challenges. I mean, where do you see potential opportunities or risks for investors in the short to medium term in the equities market here, especially with those overvaluations that we just talked about?
The first point I would make is that there's been what's often described in the financial media as a healthy broadening out since the Fed essentially confirmed their pause and then pivoted from late October through the end of the year. That healthy broadening out has really been driven by small banks and small caps in general. I think it's too early for that trade. If I'm correct that we are headed towards weaker final demand, weaker consumption, a weaker labor market, And the Fed will then react to those dynamics and start easing. That will cause the yield curve inversion, which will ultimately help those stocks. But I think we probably have one more move lower for those stocks first. So I would not be adding exposure to small caps here. I would not be adding exposure to banks at this level. We also have that capital overhang I referenced earlier. As far as tech goes, I've often described investing in tech in the US. When you think about my old equity strategy job when I was head of strategy at Barclays, if you say you're overweight tech, you're almost recklessly exposed to that sector because it's such a big part of the index, if that's your benchmark. But I would continue to be at least market weight in tech and related, which is comm services and communication services, that is, and consumer discretionary, because we are likely to have a very strong productivity cycle through the 2020s, and that will be driven by the build out of the cloud, which was the main theme of the 2010s, and now AI as one of the main implementation tools for that trend. The stocks are expensive, no doubt, but the fundamental momentum is pretty considerable. So I don't think this is the point to get too cute and get underweight tech. I do like the industrial sectors. We are having and it's something of an industrial renaissance in the U.S., rebuilding our capital base. It is, tech oriented, semiconductor fab plants and the like. But that backlog for industrial investment is just so considerable that I think that sector is one of the cyclical sectors I would stay with. I like energy. Energy is cheap. Shale has fundamentally changed the elasticity of supply. This should mean higher return on invested capital and more stable return on invested capital over time. So energy and materials are two cyclical sectors I like, along with industrials. And I just would continue to avoid the more defensive sectors, staples, utilities. I think that the bond market is not in the right place right now. We still have a huge supply problem. And at the end of the year, while I think the Fed funds rate could be 4, I think more likely than not, the 10-year Treasury yield would be 4.5, not going lower along with Fed policy.
Yeah, interesting. I mean, you mentioned energy there. It's always interesting to look over at what's happening in the Middle East, for instance, what's happening in the Red Sea, and to look at these supply challenges with OPEC and what's going on with the crude prices. I'm curious, when we look at the macro picture here globally and the global risks involved geopolitically, of course, share with us finally kind of your general overall economic outlook globally for this year, 2024, as we just begin here.
Yeah, the theme that I've been advocating for almost a decade now is a deglobalization or a degradation of the mercantilist model. And so, much of Asia is highly dependent upon the export channel. That's certainly still true of China, Japan, Korea, Taiwan, so on. And within Europe, Germany. So if there's going to be a restructuring of economic models, I would expect Germany to be the first mover. So that's the one I have my eye on to potentially start changing tax incentives to try and move away from that export-driven model. What happened to them during the Russian invasion of the Ukraine should have been a warning sign for all that stretching your global supply chains around the world was fraught with undue risk. Japan and Taiwan, Korea are all pretty leveraged to the tech sector. So in as much as I like tech in the US, it's hard to be too negative on those particular countries. And I think the UK will probably start getting their act together as well. Your own country, Canada, is a beneficiary of the energy situation. And so, those are the parts that I like. I think we've undergone some real serious supply chain risks. And as I've implied, much of the rest of the world, if you think about economies ranked 2, 3, 4 in terms of GDP, they're all leveraged to this global trade expansion, which really ended around 2011 or so. Global trade has been slowing through that entire last decade plus. So it's hard for me to get too bulled up outside of the U.S. I didn't mention LATAM. Latin America be something of a beneficiary of nearshoring and demand for commodities and the like, copper. So, on balance, I think the global economy muddles somewhat through within this broader trend of restructuring global supply chains and moving away from mercantilism.
Right. Yeah. No, well said. I mean, I could get into a whole topic there. That's a whole other interview aside. So we're going to have you on again. Barry Knapp from Ironsides Macroeconomics, breaking it all down for us today. Barry, thanks again for coming on. Lots to take from here. And I'm wishing you all the success over on the golf course this weekend.
Thanks.
Thanks for tuning in. Don't forget to subscribe to our channel for the latest and download our Kitco app for the latest breaking news. I'm Jeremy Szafron, and we'll see you next time.
Kitco News Outlook 2024 is brought to you by iTrustCapital. Buy and sell crypto, gold, and silver with your IRA.